Have you ever wondered exactly how much you need to sell before your business actually makes money? Or why some businesses are busy but still barely break even, or worse, they're losing money? The answer usually comes down to one number: your break-even point. In this video, I'll answer 3 key questions. What is the break-even point? Why is it important for your business? And how can you calculate it for yourself? By the end, you'll have a clear understanding of one of the most important KPIs you need to track in your business. The break-even point is when your business covers all of its expenses. After that, you start making a profit. It answers the big question: how much do I need to generate in sales before I stop losing money and start making money? The Small Business Administration even recommends knowing your break-even point if you want to obtain funding or prove your business can recover from tough times. It's one of the first things lenders or investors will ask about. Think of it like this: you have fixed costs like rent, payroll, and insurance. These don't change no matter how much you sell. You also have variable costs, things like materials, ingredients, or labor that fluctuate with your sales. When your total revenue covers both, you've hit your break-even point. Now, a lot of business owners guess at their break-even point, or they just look at their bank account and hope for the best. But if you're not tracking it, you're flying blind. When you know your break-even point, you can set clear sales targets, price smarter because you'll know exactly how your pricing affects profitability, catch missing expenses because you're laying everything out clearly, set realistic revenue goals, and make decisions based on facts, not emotions. It also helps you prove your business plan is viable. Whether you're launching a new product, trying to get funding, or just making sure you can stay profitable in tough times. So, here's the formula. Your break-even point equals fixed costs divided by your average price minus variable cost per unit. Let's use an example. Say you own a coffee shop. Your fixed costs, rent, payroll, etc., are $5,000 a month. You sell each cup of coffee for $5. It costs you $2 to make each cup. That's $5 minus $2 equals $3 profit per cup. $5,000 divided by $3 equals 1,667 cups of coffee. That's how many you need to sell in a month just to break even. After that, you're turning a profit. And if your business is more complex or you have multiple products or services, that's where a break-even analysis comes in. An accountant can help you run different scenarios, like different price points, sales volumes, or cost changes, so you can make smarter decisions. At CSI, we do this all the time. The basic calculation is something we walk through with you during your regular monthly accounting. So, to recap, the break-even point tells you when you start making money. It's essential for pricing, goal setting, and planning. And you can calculate it using the formula we referenced in this video, or let an accountant do it for you. If you want help calculating your break-even point, or if you need a full break-even analysis, reach out to us at CSI Accounting and Payroll. We make it easy to understand your numbers so you can focus on running and growing your business. And while you're on our website, grab our free KPI checklist, linked in the description below. It'll help you track other key numbers that are just as important as your break-even point. If you found this video helpful, don't forget to subscribe to our channel. We post videos that make accounting, payroll, and taxes easier to understand for small businesses, so you can make smarter decisions and grow with confidence. Thanks for watching. We'll see you next time.